Namaste, welcome to Arthaniti, where we discuss money and money matters to help you in your investing decisions. Imagine a world where life saving medicines become pricier due to geopolitical decisions. As global pharmaceutical supply chains face disruptions like probable Trump tariffs on pharma imports, Indian pharmaceutical companies are stepping up as the pharmacy to the world. Now, amidst this chaos, there's one company that is standing out: Laurus Labs. With its sky high PE, investors are still captivated by its growth story. Is Laurus Labs worth the hype, or are people simply betting on future hope? Well, let's dive deep into this company that is redefining India's pharmaceutical landscape. Before we concentrate on Laurus Labs, let's take a broader view about the pharmaceutical sector in general and how tides are shifting. Now, the global pharmaceutical industry is facing potential reshaping of supply chains following President Trump's announcement of implementing significant tariffs on pharmaceutical imports to the US. On April 9th, Trump reaffirmed his administration's plan to announce these tariffs very shortly, causing pharmaceutical stocks worldwide to fall by nearly 2 to 4%. This move aims to incentivize companies to relocate manufacturing back to the US after decades of production shifting to countries like India and China, where operational costs are much lower. With US pharmaceutical imports reaching nearly $213 billion in 2024, more than 2.5 times the amount from a decade ago, these potential tariffs could significantly impact global pharmaceutical supply chains and create both challenges and opportunities for Indian pharmaceutical manufacturers. Shifting back home, the Indian pharmaceutical sector has positioned itself as the pharmacy to the world, being the largest supplier of generic medicines globally. As we look forward to 2025, the Indian pharmaceutical industry is poised for transformation through several key trends. Firstly, growth in biopharmaceuticals and biosimilars. Secondly, digital transformation through AI and machine learning. Thirdly, increased focus on sustainability and green chemistry. And last but not the least, adapting to evolving global regulatory standards. Indian pharmaceutical companies are expected to face heightened scrutiny from international regulatory bodies in 2025, particularly from developed countries like the US and the EU. This evolving landscape creates both challenges as well as opportunities for companies like Laurus Labs. Now, concentrating on our subject of the day, Laurus Labs. What is its business and position? Well, Laurus Lab is a research driven pharmaceutical company specializing in three key segments. Firstly, active pharmaceutical ingredients, APIs as they are known, finished dosage forms, and contract development and manufacturing organization services. Now, the company has built a strong infrastructure with 11 manufacturing units, six of which are FDA approved sites, 73 drug master files, and 31 new drug applications. And it also has 184 patents granted. Think of Laurus Labs as a versatile manufacturing powerhouse that can produce both active ingredients in medicines and complete medicines as well, while also offering CDMO services to other pharmaceutical companies. Over the past 5 years, Laurus Labs has increased its market share from 1.05 to 1.33%, growing faster than the industry average in terms of revenue, but it lags behind in terms of net income growth. Revenue has grown at an annual rate of 17% compared to industry average of 9%. So the growth is quite good. While net income has grown at 11.35% annually versus the industry average of 15.28%. Analyzing the financial performance of Laurus Labs, it reported a total revenue of 5,273 crores for the trailing 12 months period. Now, this shows significant growth over the years at a CAGR of approximately 16.5%. But this growth hasn't been consistent across all segments. While the CDMO business has shown significant strength, the antiretroviral API business has in fact declined by 3%. This is similar to a retail business where some departments thrive while the others struggle, which requires management to shift resources and strategies accordingly. Despite revenue growth, Laurus Labs has faced concerning profitability trends. Now, net profit stands at 201 crores for the trailing 12 months, with a substantial year on year growth of 79.68%. Earnings per share stands at 3.72, again a 79% year on year growth. Operating profit stands at 876 crores, a 49% year on year growth. OPM, operating profit margins, has increased from 15% to 17% for the trailing 12 months period. While these recent growth figures look impressive, they come after a significant drop in 2024 when the net profit decreased to 162.27 crores, down from 793.43 crores in 2023. Now, this volatility in earnings make the company's profitability somewhat unpredictable. It's like a car that's accelerating quickly now but had recently experienced a major slowdown. This sharp fall in net profits in 2024 can be attributed to various interconnected factors. Firstly, there was a 17% revenue drop from 6,041 crores to 5,041 crores. Now, this was primarily because of API price erosion. Now, the drug prices, anti-retroviral drug prices, fell by nearly 20% year on year basis. Also, absence of large CDMO orders. For in financial year 2023, there was a significant 50 million one time contract, while 2024 saw delayed commercialization of new projects. Secondly, gross margins fell 233 basis points to 51.7. Thirdly, operational deleverages caused this fall. EBITDA crashed 51% from 1594 crores to 798 crores. R&D costs surged 4.8% of the revenue. Fixed cost absorptions were also an issue. Fourth, the debt and depreciation burden increased. Depreciation went up 18.7%, while the interest cost rose nearly 10%. So, these were some of the factors which caused that sharp fall in profits in 2024. Checking the valuations of the company, well, the PE of the company stands at a whooping 164, which is the highest in the industry, compared to the median PE, the industry average of 27.75. The price to book ratio stands at 7.90. Now, these valuations indicate that Laurus Labs is trading at a significant premium compared to both its peers and broader market. This valuation suggests that investors are already pricing in future growth rather than current earnings. It's like you paying a premium valuation for a 1 BHK or a one room kitchen apartment in Mumbai, thinking that rates are always going to go up in future when it comes to a bustling metro like Mumbai. Next, we'll check the cash flow and stability of the company. Well, it has an Altman Z score of 5.77, suggesting good stability in terms of bankruptcy risk. Now, what is Altman Z score? Basically, it is a financial tool used to predict the likelihood of company going bankrupt in the next 2 years. The score, the what do you say? The levels of the score are any score above 2.99 suggests financial stability. From 1.81 to 2.99 is the gray zone, and a score below 1.81 suggests distress zone and likely bankruptcy in the next 2 years. Even though the company has good financial stability, it is unable to generate free cash flows to support its business. Now, this will create significant challenges in future sustainability of the company. Imagine that you have a good salary, but you consistently spend more than you earn. Eventually, it becomes unsustainable without additional cash flows or funding in place. The debt to equity ratio stands at 0.63, which is relatively manageable. Next, we will look at growth drivers and future prospects. Firstly, custom synthesis and CDMO potential for the future. The company has recalibrated its approach towards global demand for NSE drug substances with supplies for an animal health contract starting from the second half of financial year 2024. The CDMO business has demonstrated significant achievements, with management targeting 25% of revenues from synthesis by financial year 25. This segment offers higher margins and more stable revenue streams. Regarding its formulation business, well, the management plans product launches in cardiovascular portfolio for 2024 in the US and Europe, targeting an opportunity of approximately $40 billion. Dollars. The company has increased its total manufacturing capacity to 10 billion units, positioning itself for growth in this segment. Expansion in biologics. Well, the company is expanding its biologics custom synthesis capabilities and plans to add 1 million liters of fermentation capacity. This positions Laurus Labs in the high growth biologics market, which is expected to see significant expansion globally. Fourthly, API business potential of Laurus Labs maintains a decent order book in anti-diabetic, cardiovascular, and PPI segments, supported by capacity expansion in high growth therapeutics. What are the challenges and risks facing Laurus Labs? The first and a very significant challenge is the high valuation. With a PE of over 150, the company is priced for perfection. Any execution missteps could lead to significant valuation corrections. This is like paying a premium luxury for a premium luxury car at triple its market price. The car needs to perform exceptionally well to justify such a price. Secondly, the company faces significant volatility in its profitability. With a sharp fall in profits in 2024, it raises concerns about consistency in execution and margin sustainability. Operating margins corrected by approximately 716 basis points year on year to 20.7% in the last quarter of financial year 2024. Thirdly, there are cash flow concerns. The inability of the company to generate free cash flows to support business growth is a fundamental concern that could limit the growth opportunities without additional income streams for the company. Last but not the least, potential pharma tariffs and increasing regulatory scrutiny could impact Laurus Labs' export oriented business model, particularly in the US markets. Analysts have a mixed view about this stock. According to Wall Street analysts, the average 1 year price target for Laurus Labs is 549, with a lower forecast of 401 and a higher forecast for 756. The stock is currently trading around 600 levels. ICICI Direct has downgraded the stock from buy to hold with a target of 300 on a lower side, citing concerns about execution in custom synthesis segments and margin pressures. Now, despite the concerns, approximately 45% of the analysts suggest that investors can buy this stock. To conclude, Laurus Labs present an interesting case study of a company with high growth potential but significant valuation concerns. Its PE ratio, sky high PE ratio, which is among the highest in the pharma sector, reflects investor optimism about future growth rather than current fundamental status. For investors, Laurus Lab offers exposure to high growth pharmaceutical segments like CDMO and biologics, but at a significant premium. Understanding this risk reward equation is crucial to make informed investment decisions. We are aware that investing is always about the future and not just the present. A high PE ratio isn't necessarily bad if the company can deliver growth that justifies its valuation. But it does increase the risk that if the growth doesn't materialize as expected, then we face a significant loss as investors. Uh, I hope that this analysis has helped you understand the current status of Laurus Labs and is it worth investing at this juncture or not. What do you think about this stock? Will you invest in this stock at current levels? I, for one, would not. What is your say on this? Help me understand in the comment section. If you have liked my video, please like, share, and subscribe to my channel for more such informative content. Until next time, stay safe and happy investing.